The best investors outperform in the worst markets. So if we could look inside the minds of the most successful investors on the planet, we could learn to make the most of our own investments. And this document right here, called a quarterly 13F filing, gives us the next best thing to seeing inside these investors' minds. Big investors have to file this every quarter, and it shows every trade that they're making. Like this form from 2023 showed us that billionaire Stanley Druckenmiller was betting big on Nvidia. And anyone who made the same trade at that time rode the stock to an 800% return. Or when Michael Burry from The Big Short made a long-term bet against Cathie Wood's ARK Innovation ETF in 2021. He showed us that move way ahead of time and ended up making millions when the ETF declined. But these reports can be backward-looking and pretty delayed, so I'm going to be focusing on the top 5 long-term trades that these reports show the investors are making. Because even though we can't see their trades in real time, we can still understand what they own, why, and what that says about where they see the market going forward. So let's start with an investor who's become known as Warren Buffett's protege because of his knack for picking Buffett-style undervalued stocks. So Mohnish Pabrai is known for his deep value investing and his relationship to Warren Buffett and Buffett's former partner Charlie Munger's investing style. He claims his style is to emulate and clone Warren Buffett's style. And fun fact, this guy once paid $650,000 just to have lunch with Warren Buffett. But maybe it paid off because he has had some extremely successful value plays. In 2015, for example, he bought the Indian cement company Rain Industries for 60 cents a share, and he rode it as high as $7 per share in 2018, a more than 10x in 3 years. Now, this guy's not perfect. He actually sold the stock a little late after its peak, but he's always been very transparent about his mistakes, which is great for investors hoping to learn from his moves. And his biggest holding today is Warrior Met Coal, a US-based producer of metallurgical coal used in steel making. So we'll look at why he bought that stock, but we'll also look at the broader pattern of how he picks stocks. Because the more we understand the pattern, the more we can apply it to our own portfolios and not just follow a billionaire's trades. And his reason for buying this stock ties in with his broader style of investing, looking for hidden value. And that's the lens we need to use here. So what is hidden value? Well, I'll give you an example. So in 2012, Pabrai kind of bet against the grain of the market when he made a big bet on Fiat Chrysler, a struggling automotive stock. The company had made some strategic blunders, and the market was overall very bearish on this asset. But Pabrai's bet ended up paying off, and he ended up making a 60% return on his investment. But his investing style is kind of twofold. One, find undervalued stocks like Fiat Chrysler, but two, focus on pessimistic markets. Markets where people don't seem to think the industry has a future, which definitely applies to Warrior Met Coal. So let's look at the potential here as well as the risks for investors to watch out for. So the stock is really interesting right now because the world is shifting toward green energy and coal-based energy is falling more and more out of fashion. Now this might scare off normal investors, but for Pabrai, this creates an opportunity for him to find hidden value. Pabrai said it himself during one interview that he did.
A lot of endowments and funds are not even allowed to invest in the coal industry. There's so much hatred for it. When you look in areas which are hated and unloved, you will find these anomalies. Where do I sign?
So even though coal might sound like a bad word to most energy investors, it is still going to have uses beyond energy. And one of the big uses is in making steel. But even for that use case, the supply of coal is nowhere near where it used to be. In 2022, for example, coal prices spiked due to global shortages during the start of the Ukraine war. And during this time, a lot of coal companies could have gone and taken a bunch of profits and put them in their pockets. But what Pabrai likes about Warrior Coal specifically is they decided to be very conservative with the money. They used it to build up their cash reserves rather than buying back shares or issuing a dividend, which means they're being careful and playing the long game with how they spend their cash. And we can really see this in Warrior Coal's numbers. So if I open up this stock in Forecaster, we can actually see that it's on the lower side of neutral, actually getting closer to oversold right now in terms of its stock price, meaning that it's not overhyped by the market in any way. And if we look at the fundamentals, it is actually currently listed as 77% below the fair value that we would expect from this stock based on several indicators put together, including discounted cash flow, which basically shows how much actual cash the business is producing, which in hard times, you generally prefer cash to profits because profits are kind of on paper. Cash is solid and you can use it in your business. In a recession, cash is king. They also look very solid in their Peter Lynch method, aka the PE ratio, which shows how expensive the stock is relative to their profits, basically how much investors are willing to pay for the company's profit. And in their economic value added, how well the company can generate profit based on its capital expenditures. So if you buy a new piece of equipment, how much profit does that equipment make? And all of these numbers look pretty good for this stock. And one other thing we can look at is the seasonality, which is probably my favorite tool, which basically tracks how does the stock price tend to move over a given year. So we can see in this blue line that the stock price tends to decline in the spring toward the middle of summer and then rise in the back half of the year. And considering right now we are sitting in the middle of summer, there could be some indication that the stock has some seasonal pressure upward in the next 6 months. And so even though coal as an industry is probably going to continue shrinking, it's not going to disappear overnight, especially with its use cases in metallurgy. And so for Pabrai, this stock is kind of like a diamond in the rough, since historically undervalued stocks, even in very bad markets, will tend to rise until they hit a fair value. So you remember in 2020 when oil stock prices collapsed since nobody was driving or using gas? Well, investors who bet big on oil during that time made some pretty decent returns, even though at some point we are going to reach the peak of our oil usage and then it will start to decline. And so this stock isn't like an anti-sustainability bet. It's a bet that the coal industry in general is undervalued right now because people are overreacting to its demise. And there's some data backing this up, including looking at the PE ratio for the entire industry. So we can see that coal companies have an average PE ratio of 8.6, meaning investors are willing to wait 8.5 years to get their money back in the form of profits. But compare that to something like food retail with an average PE ratio of 21, or high growth industries like semiconductors or healthcare tech. These are even more expensive. Price is what you pay, value is what you get, and there is still value in the coal sector, which is probably why Pabrai also owns shares in AMR, another coal stock that he did trim slightly recently, but today, coal is most of his portfolio, while the rest is made up of oil stocks that he bought in late 2024. Now, a quick warning on the risks here, all of these stocks are very cyclical. They tend to go up when coal prices are high and drop when coal prices are low. So I'll be on the lookout to see if Pabrai starts to sell if he sees the coal market turning, because these 13F filings are great for spotting patterns, but they give us a very delayed view of what the investors are buying. But if you're a long-term investor like me, there's still a lot of insights to be gained here. But okay, Pabrai is into coal, but what if you don't want to bet on a declining industry and try to time your entry and exit correctly? Well, let's now pivot to another investor who's made his fortune multiple times, but the most recent one he's built in AI stocks. So Stanley Druckenmiller is famous for breaking the Bank of England along with investor George Soros in 1992. So I wasn't super familiar with this guy until researching this video, but he was basically George Soros's protege. And for today's investors, what's most relevant are his recent technology trades. See, Druckenmiller was one of the few billionaires who bet big on AI early on. So his style is to basically look at the broader economy, identify the trends that he sees in the market, and then invest heavily based on those trends, with a willingness to cut his losses quickly if he makes a bad bet. And AI is solidly in his sights today, even after the recent run-up in prices.
I think AI is real. It could be as transformative as the internet.
So I want to look at Druckenmiller's latest buys, but also how he manages his trades in these long-term trends, because it's a strategy that I've never seen another investor use. And I love learning about these types of strategies because they give us lessons that we can use for the rest of our investing careers. So Druckenmiller first got into AI back in 2023 with a big bet on Nvidia, and he sold that stock after it tripled in price. But he didn't completely exit AI, he just shifted his attention farther down the value chain. So he started at the top, investing in the model creators and chip designers, then he moved one step down the chain to stocks like Palantir, companies that are using AI in their applications. And that stock has had an amazing run since he bought into it. But now he is moving on to the next stage in the AI ecosystem where he sees the best value in manufacturing. So he's been buying shares in Taiwan Semiconductor Manufacturing, or TSMC, the world's largest contract chip maker and a key supplier to companies like Apple and Nvidia. And here's the big thing. While TSMC's stock price is up, it is not up nearly as much as some of these other AI stocks. And TSMC has some pretty good things going for it, both in the short term and in the long term. There's been a big push recently for US investment, $100 billion, into 5 US-based fobs for this company, with US subsidies helping to make that space even more attractive. This helps lower the risk to this stock from geopolitical tensions. The company also has a very stable smartphone business, so even as they're investing into AI chips, they have a solid base of revenue to work off of. They can keep on making iPhone chips while they invest more in their AI chips business, which you can see in their changing list of top customers. So the timing of this trade is kind of interesting because it comes at a period when Druckenmiller is mostly moving out of his AI stocks. He bought shares in companies like DocuSign, Roku, and AppLovin, so he's still in tech, but his AI focus is now squarely on manufacturing. So unlike a lot of AI stocks nowadays, TSMC's financials actually look fairly good. If we look at their Altman Z-score, which is a way to measure how likely a company is to go bankrupt, they are solidly into the safe zone. Anything above a score of 3 is considered very safe, and they have a score of 8.5. On top of that, their Piotrowski F-score, which measures how stable financially the company is, also rates them as very stable with an 8.0 score. The seasonality chart does put them a little bit on the higher side for this year, and oh, what's this? There's an AI summary of the business. Oh, all right, that's kind of cool. So this tool that I'm using is called Forecaster. I've been using it a lot more recently for some of these kind of aggregate metrics to get a quick overview of the company, and of course I really like their overbought versus oversold indicator. Looks like for TSMC they think it's actually a little bit high, but I'll leave an affiliate link in the description and pinned as a comment if you want to try it out. I think you get 10% off if you use that link. But okay, outside the numbers, another reason that Druckenmiller might be going for TSMC is he sees them as a source of stability in the AI space. So we've been seeing a lot more uncertainty and volatility around trade, especially between the US and China. And this is really interesting because the current US Treasury Secretary, Scott Bessent, has actually been a close friend of Druckenmiller for years and even considers him a mentor. And so Druckenmiller's recent trade could actually be connected to his criticism of US trade policies and his uncertainty with how they could affect the economy going forward. Basically putting his money into the one AI company that everyone else relies on, Apple, Nvidia, AMD, because this stock has really strong strategic and financial footing. And it doesn't hurt that he seems to have an inside line to the US administration. And side note, there was this really interesting study, not so much about stocks, more about geopolitics and political game theory, but it lays out why companies like TSMC are so important to global negotiations right now. So I'll share that in the description if anyone wants to go deeper on that. Just thought it was really cool. It's hard to say exactly why Druckenmiller made this trade, but it's interesting to see the pattern he uses of identifying an investing trend and then investing in different companies moving down the value chain over time. It's a strategy that I've never seen before, but I'm probably going to look into it more in the future because it seems really interesting. Now, even though Druckenmiller is a good person to watch, one note of warning is to be careful because he does trade very quickly, and so using his 13F filings to copy him might leave you holding a stock that he's already exited from. I would mainly use this report for the broader patterns in his trading specifically, especially with the current shifting US trade balance and global politics absolutely being a major risk for TSMC in the near term while they're still building out their US capacity. So an interesting pick to keep on our radar, but now let's turn our attention to an investor who's known for making very big, very slow bets. But when they pay off, they can also pay off big. So Michael Burry is next, and if you don't recognize him, he was played by Christian Bale in the movie covering his famous prediction of the housing bubble before the whole market collapsed in 2008. He ultimately ended up profiting $700 million for his investors and over $100 million personally off that one trade. So Burry only made one purchase in his most recent 13F filing, and even though that purchase was probably made months ago, but there's a really interesting pattern that Burry may be trading here. So Burry put 13 $15 million into a beauty stock called Estee Lauder. This is a company that sells beauty and skincare. It's a lipstick stock. And the company's stock price is down 33% over the past year, although it is likely up from where Burry first bought it. So I'll cover why Burry bought this stock in particular, but I also want to cover an interesting angle on why he may be buying a lipstick stock at all. So Burry is famous for spotting patterns that appear before a market crash. He did it in 2008, he did it again in 2021 for Cathie Wood, but he's also sometimes spotted some patterns that didn't really exist. But even so, this theory is worth spending a moment on, because if it's true, it could be a sign of Burry's biggest bet against the market that he's made since 2008. So Estee Lauder belongs to a category of companies which are often called lipstick stocks, and this type of stock often acts as an indicator of future economic recessions. So Burry, by buying this, may be making a prediction that the US is headed for a recession. Now, this sounds really strange, but let me explain how this reasoning works. So during a recession, you would normally expect consumers to spend less money, and they do. There are plenty of studies that show this. But for some reason, the beauty category specifically tends to see increased spending during a recession. Maybe it's a confidence boost when everything feels terrible, I don't know. But you can read this paper by actual psychologists if you want more details on why the lipstick effect exists. But what matters to investors is lipstick stocks like Estee Lauder will tend to rise as spending increases, and spending increases when we see signs of an economic recession. So in a weird way, recessions can actually boost beauty stock prices, which we actually saw in 2008. The Great Recession kicked off the strongest bull run that Estee Lauder stock has ever seen, far outpacing the S&P 500 in the bottom chart over that same period. So if we hit another recession, Estee Lauder could outperform, and I made a whole video going over 4 indicators of what we might see in a recession. But the other possibility is Burry just thinks this stock is a good value. They're in the middle of a major turnaround plan, and the CEO is focused on boosting sales growth. So let's look at a couple numbers behind this stock that could make it a good buy even if we don't see a recession. So if we look at the company's fundamentals, they are currently listed as slightly more expensive and above their fair market value. And they're actually in a moderate risk of bankruptcy, which we can understand by their revenue and profits slowly dropping over the years, which contributes to their Altman Z-score, a measure of financial health, dropping. But at the same time, the stock does seem to be stable financially, so unless something really bad happens, they'll probably be okay. But with some of these negative indicators, it seems to show that betting on this stock is really betting that the CEO can turn things around and improve where the company currently stands. Looks like the CEO thinks it will take about 6 months. Fiscal year 2026 starts in October for this company. Oh, and this is interesting. Apparently there are a bunch of politicians who are trading this stock as well. But personally, I'm going to be holding off on buying this stock for now. If we see an economic recession, now you know, this could be a stock to buy. But now let's look at someone who's less focused on timing the market and more focused on spotting the next great technology winner in the market. And after that, I'll cover Warren Buffett's biggest recent trades, focusing on the long-term bets, since as you know, these 13F filings can be fairly delayed. And before we get there, quick question for you. I personally care more about the investors' strategies that they use for buying the stocks rather than copying their specific trades. But I'm curious, do you care about the patterns and strategies they're using? Or would you rather I just focus on specifically the trades that they're making? Let me know, because I'll probably make a follow-up video to this in a couple months when we get the next 13F filing, and I can change up the format if you think it'd be more valuable. But okay, let's get to our next technology investor, and then we'll get to Warren Buffett's trades. So Bill Ackman is famous for beating the market year after year after year after year. He first made a name when he shorted MBIA stock, one of the insurance companies that helped prop up the housing bubble that led to the 2008 housing collapse. That company's stock price completely dropped with the housing market, and today it trades for less than 1/10 of the value it had at the time, making Ackman's Pershing fund a tidy profit off of that short bet and building his reputation as an early spotter of investing trends. So recently, Ackman has been very focused on buying businesses that make a lot of cash, have a strong market dominant brand, and aren't crazy risky or complicated. And he's been making some very good returns off of this more recent strategy, like he did with Chipotle. So his most recent report has been focusing a lot on transportation companies, including Hertz, a major car rental company that is currently recovering from bankruptcy, and Uber, in a huge new position that he's dumped $2.2 billion into. So we'll focus specifically on his Uber bet, and there are two big reasons for this bet based on what I've seen him say publicly, as well as one big risk that we'll want to watch out for. So first off, Bill Ackman, like a lot of the investors on this list, has been very concerned with the US's inflation recently. In fact, he actually shorted treasury bills back in 2023 and made a decent profit by basically betting that inflation would stay high. Now, recently, inflation has cooled off a bit, but there's still a lot of uncertainty about what might happen next in the economy. And in times of uncertainty, strong brands that have a lot of pricing power and produce a lot of cash have a lot more options to maneuver and even gain market share, especially considering Uber is basically in a duopoly with Lyft right now, and the company has been performing extremely well in terms of their earnings. So if we just take a look at this company's sales over time, we can see that their revenue has been absolutely exploding recently. And even though historically they have not been a profitable company, they're at almost $10 billion in profit in their most recent year. And for Bill Ackman, because he's really focused on cash, Uber's cash flow has also started to look pretty impressive recently. But the bigger play here for a technology investor is how Uber can grow over time. So as interest rates rise, that actually makes car ownership less attractive, potentially boosting the demand for Uber. Why would I deal with all the hassle of owning a car if it ends up costing more than just calling an Uber now and then? And the company also has opportunities to expand into freight or shipping with their already pretty large network of $20 billion in freight under management. And then secondly, this bet on Uber could actually tie in with Ackman's previous bet on Hertz. Now, this one's a little more speculative. Hertz is a company with a ton of debt and a messy structure that eats into profits and needs to be cleaned up. Something that could partner very nicely with a company like Uber that has no physical infrastructure and tons of demand for vehicles, especially as autonomous driving becomes better. Now, that's a pretty long-term view, but as we are entering an era where autonomous driving is becoming a real factor in the value of transportation companies, autonomous driving is something that we're gonna have to start considering. And with Uber specifically, a lot of people view self-driving cars, especially Tesla, as a fundamental risk to Uber's business. Because if someone can just have their Tesla drive around and drop off customers for them, why would they sign up to be an Uber driver? But while this is a real risk, and if Tesla has their way, their robotaxi network will be the future of transportation, Bill Ackman actually argues that this risk is being overblown, saying the long-term risk to Uber from autonomous vehicles is limited. Because one, he doesn't believe AVs, autonomous vehicles, will be able to replace human drivers for quite a while, and two, he thinks AVs would actually expand the marketplace for rideshare, not drop it. So while a company like Tesla might become a new competitor in the space might just grow so much because it's much cheaper to run an AV than to hire a real driver, that Uber still ends up benefiting. Especially considering Uber already has their network of passengers and they are partnered with many of the leading self-driving car companies, including of course Google's Waymo and smaller companies like WeRide and May Mobility. And I kind of agree with Ackman. Even if Tesla is the first to roll out autonomous driving, they're not going to have a monopoly in self-driving. Eventually, the technology will spread, and when it does, it'll probably benefit companies like Uber, especially given their CEO is really focused on partnering over competition. Now, I actually did a deeper dive into how Uber fits into the AI space in a video made last December on the top 4 AI stocks billionaires are buying, and since then, Uber's stock price has had a pretty good year. So it's worth keeping an eye on this company and whether they can maintain their current growth, especially as they roll out their own self-driving while Tesla is doing theirs. Which leads us to our biggest investor of the bunch, arguably the greatest investor of all time, Warren Buffett. And if you've gotten anything valuable out of this video so far, maybe share with a friend who you think could learn from these investors. So Buffett's latest moves have been pretty dramatic. You may have seen the entire video I made just covering his latest 13F filing, but I'll give you the short version. And then after Buffett, I'll also share one bonus trade trade from someone who is secretly one of the best performing investors of the last 30 years. So Buffett is currently holding more cash than he has at any point in his career, over $300 billion. And at the same time, he has been selling more than he's been buying, especially in US stocks, which may imply that he's not super confident about the state of the US market going forward, especially when we look at some of the warnings he gave during his last presentation as Berkshire Hathaway CEO.
The value of currency is a scary thing. Fiscal policy is what scares me in the United States.
So I made a whole video on Warren Buffett's warnings, and long story short, it appears that Buffett is actively betting against the US dollar, especially when we take into account how he reacted to a similar situation back in 2003. And that's another story for another time, but Buffett's most recent purchases has been in a basket of Japanese stocks. And while this isn't a recent move, he's actually been investing in the undervalued Japanese market since April of 2023. Even today, the average PE ratio of Japanese stocks is lower than equivalent US stocks, with the lowest price to book value, or PB ratio, of any of the top G7 countries, which means that when you're buying a Japanese stock, the price you pay is much closer to sort of the baseline value of their assets than if you were to buy a stock in the US, for example. This means a lot of investors see these Japanese stocks as safe havens because there's only so far they can drop if something happens in the market. Assuming, of course, the stocks don't just stay stagnant forever, which has been a big risk with Japan's GDP growth often hitting zero or even going negative in recent decades. So look at this chart of the Nikkei index. It's kind of like the S&P 500 in the US, but for 225 major corporations in Japan. And it's gone up over time, but nothing even close to the growth of the US market in the last quarter century. So Japan's market has been struggling, but in his latest 13F filings, as well as his final speech as Berkshire Hathaway's chairman, Buffett seemed pretty confident about the future of these 5 Japanese stocks, saying he hoped to keep holding them for probably the rest of his life. In fact, Berkshire's future CEO and Buffett's longtime vice chair, Greg Abel, says they plan to hold the Japanese investments for 50 years or longer. Now, even though Buffett probably thinks of these stocks sort of as one basket that he's investing in, we gotta pick one for this video. So here's the 30-second summary of the biggest of the 5 stocks, Mitsubishi, and how it looks as an investment to regular investors. And then we'll get to the bonus stock from Nancy Pelosi. So Mitsubishi is a holding company that operates across 8 very different business groups: energy, materials, cars. They own companies that operate across the spectrum. And Buffett has praised their very strong balance sheet as well as the discipline they've had in returning value back to their investors through strong dividends as well as through buying back shares. We can see how the total share count has declined in this chart, which means any existing shares you held in the stock would get more valuable, or at least see upward pressure on the price. So here's an interesting note. Buffett agreed not to buy more than 10% of the shares in this or any of the 5 Japanese trading houses, maybe to avoid any appearance of a hostile takeover. And this is from the Berkshire shareholder letter, by the way. But he now owns 9.7% of the company. And the 5 companies have actually agreed to moderately relax that 10% limit over time. So Buffett is probably going to be buying even more shares in these stocks as they allow him to take a bigger piece of the ownership, which could be a good sign for any investors looking for some international diversification in a long-term holding, which, as I've shown before, diversifying not just between industries but between countries seems to be more stable than only investing in the US. But now let's look at a politician who has managed to not just outperform the market once or twice, but for most of their investing career. And before we show that trade, the biggest lesson here isn't just to copy these investors' trades. It's to look at the techniques and strategies that they use so we can adapt them to our own portfolios. What separates the experts from the amateurs is the experts create a plan and follow it, and they adjust the plan when the data changes. So our bonus investor is Nancy Pelosi, whose husband Paul has outperformed the S&P 500 for years, and who I went way deeper on in this video. And their last major trade hasn't been since January, when they bought 50 call options in Tempus AI, an AI healthcare stock. You can watch my top Congress stocks video for more information on her recent trades, and if you want more investing news, I post daily breakdowns over on Instagram, and the data is telling YouTube that this is the next best video for you to watch.